Hello, everybody. I'm Michael Smith. Welcome to the Lowdown. Last week, I did a midsummer check-in, and it was brief. And this week, I got Kevin Lennox joining me, and I thought we'd take a deeper dive on some of the big topics right now that we're hearing. Where are we? Where have we been? And where are we going? And so, Kevin, I thought maybe you would start off with the current rally and kind of get your thoughts. I mean, many people thought, especially at the beginning of the year, they thought that we were not going to see a rally. As a matter of fact, the bears were out, full claws, ready to attack, but they couldn't have been more wrong. We've seen this rally, just despite any negative news, we've seen this market's been pretty resilient. But I think many people wonder, how much more legs do we have, and maybe what was the big attribution? Why did this surprise so many people?
Yeah, it was a complete surprise. I'll throw myself in that camp as well. If you are looking at just a host of conventional leading indicators in this business, most things pointed to a recession.
Sure.
Banks were certainly tightening credit, and then we had the bank shock in March, which I think reinforced that.
Mm-hmm.
But I think two letters changed everything.
And what's that?
AI.
Oh, yes, artificial intelligence, ChatGPT 4, 5, whatever it is now.
And the Magnificent Seven stocks, which through the end of May accounted for 100% of the rally in the S&P 500. And it changed sentiment. It changed positioning. So many people were underweight stocks or in cash even.
Yeah.
And then FOMO kicked in, which is what we talked about last time.
The fear of missing out.
So if you're a portfolio manager and you were very smug last year about outperforming being defensive, I'll sort of put myself in that camp too, then this year hit, and thank God we did get super defensive. As much as I thought we should, the core satellite structure, where you just do a few things tactically based on the business cycle, I think really helped us stay in this market. And I've said several times, I think on this show, successful investing is pretty much predicated on who can stay long the longest.
Well, and that's why you don't make drastic changes. I mean, you're never advocating. Even though we had a bearish slant, you're not advocating for someone going all to cash. That's why you never make those big drastic decisions. You always got to stay invested, but rotation, as we talked about, those are different, and having some different themes, those are things to continue with. And then financial plan should tell you how much equities to stocks or equities to bonds you should have in your portfolio.
Exactly. And we always reference that with clients in a review meeting. And then we had the bank shock in March, a significant response from the Fed and Treasury, which then caused financial conditions to loosen all the way back to where they were in February.
Yeah.
And then we start to see this market broaden out. The pain trade was if cyclical stocks would start to catch a bid and rally. And at the end of at the end of May, we started to see that.
Sure.
And then we saw small cap stocks start in early July, as a catch-up trade, really. If you've missed it, where can you go? I think it's dangerous as hell, because I still think there's a high chance of sticky inflation, slower growth, tighter lending conditions, which will hit small caps disproportionately. And now we've seen energy really pick up this month. So a broadening out of the market, which helps the wealth effect, which helps sentiment. Corporate earnings continue to be much better than feared.
Yes.
And now the concerns about recession have been reduced by most firms.
I mean,
as data has gotten better.
Well, isn't really everybody now in the soft landing camp? I mean, while I feel like that's kind of where we are, I also have a little sense to me, that sense when everybody's kind of on that same page, you might want to start wondering what could sneak up and catch this right now.
Yeah. Just like the end of last year.
Yeah.
Pure consensus for a recession. Now after the last CPI print, which was very soft.
Yeah.
Really over the last couple of months. But then you've also had Brent oil staying in a $72 to $78 range through May and June, notably lower price than previous months, and now we're at 83.
Yeah.
Now we're seeing grain prices, food prices start to move back up. So the sticky inflation, the disinflationary trend may be transitory.
Well, let's actually
play on word from the Fed.
Well, let's talk about inflation for a minute, because I mean that was last year. If you kind of think about it, that was the biggest topic. I mean, everyone was freaking out about inflation. I mean, notably, everyone's seen the cost of just about everything go higher. But now we're starting to see that, at least the CPI report, that's come down significantly, right? The Fed's getting closer to 2% target, on what they see. But I guess the one big factor in there is the shelter component, which is the lagging. It's 33% of the CPI, and that's lagging. And even though I think there's new construction that's coming online, that could take it several years before it really brings that down. But I think, and you and I talked offline, but a lot of people don't realize inflation isn't kind of a one and done thing, right? It comes in cycles. And if we look at the previous inflationary cycle, and the only one we can really go back to is the 80s and the 1980s that we had, an inflationary period, which was pretty drastic. But it came in 3 cycles. And I think arguably we could say we're through that first cycle, but I wouldn't be, hitting the victory bell just yet. And maybe kind of explain how and what could cause these inflationary to come back in the waves that we're talking about.
Sure. The economy always ebbs and flows. And there are periodic growth scares and inflation periods where it's higher than others, and it's mostly cyclical. I would argue that with the transition to fiscal policy as dominant tool across the G7 to boost economies, that inflation now is structurally going to be at a higher level than 2%. Probably that 3.5%.
The new normal will be the 3 or 4, right? Yeah.
Exactly. We have embarked on a policy of deglobalization, away from just-in-time inventory, where goods were manufactured by the lowest possible producer, and that costs money.
Yeah.
And I think we have a chart here, the manufacturing construction. So construction of manufacturing firms from the Inflation Reduction Act and the CHIPS Act.
Yeah.
And the spending is parabolic. And it costs more to produce here.
Absolutely.
It does. So unions have gotten more and more leverage in negotiations. We're seeing broader wage increases. We'll get a report on Friday, the ECI, Employment Cost Index, which is a quarterly measure. And just like most things, you look at 2 or 3 of those to get a sense for the pattern. And all the destocking we did globally of oil and commodities last year to lower the price, those, I think, influences have largely abated. And now we're looking at a tighter energy and, I would say, industrial metals markets as well, which I think keeps a higher structural level of inflation in place.
So, don't count inflation out. I mean, so definitely, again, like you said, ebbs and flows, lots of components that could lead to that. So I certainly agree with that. So just, want to keep an eye on. And it's going to be a continuing challenge. And as a matter of fact, talking about the Fed, maybe kind of get in to where do you think now, here we are mid-year, we got a Fed meeting very, very soon coming up. What are you thinking the Fed is positioned to do right now? How are they poised? I mean, I feel like they could really send this market the wrong direction if they're not careful. And we always talk about how crafty they have to be in their commentary. But where do you think the Fed goes from here? What are your thoughts on that direction?
Yeah, so the Fed announcement will be in about 3 hours.
Okay. Well, I didn't want to say how close it was. So yeah.
The expectation is they will raise
Yeah.
by a quarter point. The market has basically priced that in.
Exactly.
The Fed has not gone against that. So that's the expectation. And it doesn't matter whether they hold here or they raise another quarter point. It's what happens down the road.
Yeah.
And where will we be at the end of the year? And if inflation stays sticky, my guess would be they'll probably want to hold for a while and wait and see if they need to go higher. But the consensus is that they're done after this meeting.
Okay.
We will see.
Well, if only Jerome Powell could come out and just say, hey, we're going to raise a quarter point and then leave, then the markets, they've already priced that in. But again, sometimes he has to add commentary. And that's where he's had many slips, right? So let's just hope he doesn't have a slip.
The press conference afterwards is always much more entertaining than the actual announcement, because that's when Jerome Powell's true self comes out.
Yeah.
his inner dove will come out in a comment or two, historically.
Yes.
That boosts the market.
Yes. Let me ask you on the recession front. Here we are mid-year. We've gone from, hard landing, soft landing several times here in the early part of the year. Right now, it seems like everybody's in a soft landing camp. But where are you kind of feeling the recession call, or at least the recession? What does that look like for you right now?
I think we're going to have a recession. I think it'll probably wind up being on the moderate side.
Mm-hmm.
But it's taken longer than most have said. Most people are saying soft landing for now.
Yeah.
But most still have recession at some point out next year. What we are seeing, we talked about, kind of a K-shaped economy,
mm-hmm.
in that, auto delinquency payments have escalated, mortgage delinquency has escalated, credit card has really jumped, and balances have jumped at a time when the average APR rate is 20 to 22, 24%, I think. So the more vulnerable consumers are really feeling the pinch from inflation and higher cost of credit. On the business side, I still think leverage loans are a potential area of systemic risk. The leverage loan market, which are packaged bank loans, by leverage companies, and a lot of companies have gone from the high yield market to the leverage loan market because just the terms are easier. So many investors looking for higher yields have found it there.
Mm-hmm.
The idea of a floating interest rate when rates are moving up makes sense, but there's meaningful credit risk there. And the Fed issued a paper, I think 2 weeks ago, showing that the number of companies in financial distress was the highest since 2009, 2010. And so weaker consumers, weaker businesses really feeling the pinch here. And does that move upstream?
Yeah.
My sense is it does, the longer that the Fed has to keep rates higher because of sticky inflation.
Well,
that's my base case. Now that doesn't mean the market crashes.
Exactly.
But you pointed before to areas of the market. How would you deal with a government that is just printing too much money? Well, we've talked about the quality area
mm-hmm.
of the market to invest in, and many of those companies are either semi-monopolies or oligopolies.
Yeah.
They have huge advantages with respect to
large moats.
Exactly.
Yeah. Sure. So right now, investors protecting themselves, higher quality, good cash flow, low debt, lower debt in the United States. That won't be too hard to find, right? And then what about fixed income? I mean, here we are, lots of people talking about, getting into one-year CDs. I think these short-term, high rates are traps. I mean, people are not realizing when those mature, rates could be lower. But where do you think that where an opportunity is maybe in fixed income? Where do you see that as far as along the curve?
That's a tough question for Shark Week.
Yeah, yeah, true. Yeah, the Fed's about to make a call, right?
There is no fat pitch right now in fixed income. We've got a massively inverted Treasury yield curve,
mm-hmm.
where the 10-year Treasury yield is 3.9% and the 2-year is 4.9%. So, with the base case being more sticky type of inflation, I think the best place to be is in the short to intermediate part of the high quality aspect of the fixed income market.
Okay.
To reach for maturity here, I think would probably be a trap. And just to stay in cash could equally be a trap, because if we hit an air pocket in the market,
sure,
and you're in cash, then you're not going to be able to reinvest at a reasonable yield. Where these yields in the short to intermediate part of the curve are basically at the long-term average return of bonds over a long term.
Mm-hmm.
If you look at a 60-40 model.
Yeah.
So why not pick that up and mitigate the risk of either a hard landing where you can't reinvest, or inflation that stays sticky that allows you to reinvest maturing bonds at a quicker pace?
Absolutely. It's been a long time before anybody's really been able to recommend getting into, a little bit intermediate or longer term bonds, we haven't seen yields at this level. So definitely good advice. Well, Kevin, look, I think this has been a great midsummer, mid-year check-in. I think we have a lot that's going to be coming up, but we'll have you on next month, and we'll certainly have a lot to talk about. And of course, we'll know what the Fed decides and kind of what if Jerome Powell, does he stick his foot in his mouth, or does he give us good guidance? We'll see. But thanks for joining us. And if you want to get a hold of us, avidianwealth.com is the website, and we'll see you next time. Thank you.